Good evening, everyone. Can you guys hear me? Good. Okay, wonderful. Good evening, everyone, and happy New Year. Happy 2025. We're excited to be here this evening. This is our first membership meeting for 2025. That's right, Madam Kim. If you can come on the screen, jump online with us. We want your energy. We want to see those beautiful faces. This is our first meeting of the year. We're kicking it off with high energy, and we're super, super excited to come back in person really, really soon. But for January, we want to talk and start off the year with our real estate tax basics. When we think about tax basics, we're not saying basic because it's information that you should know. It's information that's foundational, right? And many of us are first generation entrepreneurs. And so what I've learned is coming from an employee mindset to an entrepreneur mindset. Sometimes there's a shift that needs to take place. There's information that I wasn't necessarily privy to. And I realized I might have been paying a little bit too much in taxes. So today I'm excited that we have some of our very own professionals to help us preserve, protect, and retain some of the wealth that we're building in real estate. That's what we got into this business to do, right? To build wealth. But we want to make sure we are set up to do so. So before we get started, I want to take a moment and take a step back and acknowledge our board of directors, our 2025 current board of directors who worked so hard to bring you guys important educational programming as well as information throughout the year. So I am the president, Sanina Ellison Jones. Help me welcome with a virtual wave to all of our board of directors, our first vice president, Madam Fosta Wilson, second vice president, Madam Cecilia Marlowe, our treasurer, Madam Kim Collins, our secretary, who's also going to be on our panel today, who's a tax expert, Madam Patrice Stewart, our chaplain, Madam Millie Reyes Williams, board of directors, Natasha Robinson, Siobhan,
Hey,
Brian Williams, Joyce Gibson, Brother Felton Ellington, Madam Tara Flowers, Brother Jacob Handelman, who will also be presenting today, who's an awesome attorney, brother and past president nationally as well as locally, Brother Ron Branch, Madam Candy Thomas. So once again, welcome to our board of directors. Thank you all for all of your hard work and all that you all continue to do to bring us this great programming. So without further ado, welcome. And I'm going to turn it back over to our first vice president, Madam Fosta Wilson.
excellent. Thank you so much.
Hey, Curls, Patrice. I see you curling, bouncing and behaving. Okay, bye.
I love it, Madam President. Yeah, she had to show up like this. Hello, I'm here. Outstanding. So we have a lineup for you from our board of directors, as Madam President mentioned, Brother Jacob Handelman and Madam Patrice Stewart. We want to absolutely kick some things off with sharing exactly who you guys are and what it is that you do, and then we're going to jump right into our panel discussion. It will go back and forth amongst you guys, your two experts. Okay, so if it's okay with you, Brother Jacob, can you do us a huge favor and introduce yourself?
Hello, I am Jacob Handelman. I am an attorney of something like 30 years. I prosecuted for the city for 15 years, and actually, even while I was there, neighborhoods were really important to me. And I've found ways to improve the neighborhoods and help people that are in the neighborhoods keep an active role and be able to invest in their own neighborhoods. And that's what I'm trying to do today. I am thankfully, as you know, a board member of the Dearborn board, and I'm going to be talking about 1031 exchanges today.
Outstanding. A little bit more than 1031 exchanges, because we know you bring such a wealth of knowledge in reference to the real estate taxes, and you've done a great deal in the community. You being shy, Brother Jacob. I don't know why, but we know you've done so much for the community, but we'll get into that. Next up is Madam Patrice. Come on, Madam Patrice, and let the people know who you are and how you're able to speak on taxes.
All right. Good evening. Good evening. Welcome, everyone. Thank you. Thank you, Madam President and Madam Vice President, for the beautiful compliments. My name is Patrice Stewart. I like to go by, I'm the Realist Tax and Business Strategist. I have that trademarked. And one of the reasons why I go by that is because I'm very honest, I'm very open, I'm very real with my client base, because I want you all to get the information that you need, right? It's a lot of misinformation out here in the world regarding taxes, different types of write-offs. A lot of entrepreneurs really write too much off, and they really don't understand that, especially when trying to buy real estate. So I do have 21 years of experience in the financial services industry. I was a banker for 7 years. I actually used to work for BMO Bank as a banker there. And then I also have been in the accounting and credit services the other 18 years that I wasn't working for BMO. So I've been doing taxes on my own. I have my own firm for over 20 years as well. So I'm just very passionate about our people understanding the real knowledge of finance, information, taxes. So taxes is a very wide, broad range. And so we'll get into a little bit of that tonight to help you kind of understand. So, and I'm also on the board as well as a secretary. And I'm will also kind of consider myself like a community advocate. We do a lot of classes, workshops for the community to try to also help educate. So thank you.
Outstanding, Madam Patrice, Madam Secretary. Thank you so much. I'm just going to go over a couple different house rules before we jump right into the conversation. If you're just now joining us, please do us a huge favor and mute your phones. We don't want you to interrupt the speakers, or we don't want you guys to miss any information, since we have a treat. We have the board of directors on here tonight sharing their expertise and their knowledge, and we want to make sure that we soak up everything coming into this new year. So we're just going to jump right into it, Madam Patrice, since you are the tax expert, right? And with a lot of our members being self-employed, share with us some tips on being self-employed and what you can write off and Schedule Cs and things of that sort.
Okay. So I do have like a little PowerPoint presentation, but I'm not going to bring it up yet. I'll hold it off for just a moment. But I want to say we also say everyone can be self-employed, right? And then entrepreneurs again is broad, right? So I always like to break down and ask the question, how many of you on here are an actual LLC? If you're an LLC, type in the number 1 in the chat for me. If you are a corporation, type in the number 2 in the chat for me. If you are a partnership, type in the number 3 in the chat for me. And if you are a sole proprietor, which means you have not formally registered, but you're running a business, then type in the number 4 for me in the chat. This helps me also kind of understand who we have on and what I should be talking about, because I don't want to kind of bring up topics or corps that we're not going up. So a lot of ones in here. Okay.
Mm-hmm.
1, 4. Okay, we have a couple of 4s for for the sole prop. So 1s and a couple of 2s and 4s. Okay, we got it well versed, but majority of people are LLCs.
Yep.
Basically. Okay.
Yep.
So great top. That kind of where I wanted to go. So I like to always go into business is not a one size fits all, right? It's really going to be based off how you are set up, how you are registered, what your entity structure is, right? So that's why I asked you all to kind of let me know where you are. So for LLCs, the next question that I'm gonna have for most of you are, if you are an LLC, are you a single member LLC or are you a multi-member LLC? So if you're a single member LLC, type in 1. If you're a multi-member LLC, type in 2. All right, which I figured a lot of people are single member LLC. All right, Jacob, you got both. Okay, so when you are a single member LLC and you file and you register your entity structure, most of you are going to be automatically set up as a disregarded entity, right? So what does that mean? A disregarded entity in the eyes of the IRS means that you're going to be taxed as a sole proprietor, okay? So setting up your business structure is one portion of business, but then knowing how your business is going to be taxed is the other part that a lot of entrepreneurs miss, right? And so this is kind of what we want to go over tonight. So when you're a single member LLC, even though you're registered, and when I say registered, you are your company is registered with the Secretary of State. You have articles of organization. You have an EIN, right? You're a formal business entity, right? But tax-wise, you all file the same as a sole proprietor. So for those who typed in 4 that are a sole proprietor, you all are on the same tax form, which is attached to your personal tax return as a Schedule C, okay? So the Schedule C tax form is one of the most common tax forms that we file with business. A lot of entrepreneurs are registered as self-employed or single member LLCs in this country, right? So you're going to be taxed differently than someone who's a corporation. You're also going to be taxed differently from someone who is a partnership or someone who may be set up as an S corp. Okay. Now, with that being said, since we have more LLCs on here, I'm going to pull up a screen to show you all kind of what your standard deductions are, right? Because you can have standard deductions across any business, right? There are standard business deductions that all of us, no matter what business we are, can use. And that Schedule C is kind of that standard form, right? The other form that you also might want to consider, and we'll get into this a little later on, is where your income is and maybe looking at some other options as far as how you're being taxed, right? Because that's what we're here to talk about is the tax savings, right? What type of tax savings or tax strategy. So the basic deductions on a Schedule C are kind of standard, right, for everybody. But then as we start getting into your specific industries, a lot of you on here are probably real estate owners, real estate investors. So again, that's going to be another type of tax strategy that we're looking at, because now we're looking at your property, we're looking at other assets that you have that can also be deductions, like something that we use as depreciation, right? But I just like to always go into that part to start off with, to let everyone know, first, we need to look at your entity structure, how you're set up, and then how are you actually being taxed right now? And then once we look at your overall structure and we can see the amount of money that you're making and maybe some of your expenses, some of your income, then we can look into how can we strategize some different tax strategies that would help you. Does that kind of make sense?
That absolutely makes sense. We know that it's standardized deductions and then this itemized deductions. But you know that we're here to find out how we can itemize our deductions and find out about this depreciation. So we eager to jump in and find out about that, Madam Patrice.
Okay. Well, I'll make sure that I get the a PowerPoint screen up and ready now. You know, I was running a little bit high, so I'll bring it up after Jacob is finished and I come back on. Then I'll show you all a little bit of the presentation that I have.
No problem. So then what that kind of ties into, you mentioned the Schedule C, the tax tips for the 1099s. So we can kind of bounce over to Jacob, if that's fine with you, Brother Jacob. You on mute.
It still sounds good to me.
Okay, great. So with you, Brother Jacob, tell us, what are some of the tips that you see when you're working with entrepreneurs and they're coming to you with purchasing properties and the property taxes on your end?
The two things that are most prevalent are to try to make it so that you pay as little as you have to in taxes on your property. That's the part that I'm with. The two places where property and taxes related to them most frequently, unless you guys tell me otherwise, is general yearly property taxes. And the second thing is when you're selling property based upon the increased value, one must pay taxes based upon the increased value. Patrice, would you say that there's anything different, or would you agree with me that for the properties, those are the two most common things to be considered with?
Yes, the taxes and the interest.
Right. Okay, so I'm not planning on talking about property taxes too much today unless that becomes a question. I was a hearing officer for the Property Tax Appeal Board. So, but mostly the property taxes are based upon the value of the property and the type of property it's in, the type of property it is, and the neighborhood that it's in, and the different taxing bodies that are there. Happy to talk with any of you. I don't appeal taxes myself, but I'm happy to give you a referral to another attorney that does do that.
No problem. What if you
The
can jump right into like the 1031 exchange then, Brother Jacob? What is the 1031 exchange and why is that so important?
So a 1031 exchange is particularly important because for uh, for income producing property, when you sell it, you have to pay taxes on the increased value of that property that you have sold. So if you can minimize the amount of taxes that you're paying on that and roll it into another deal, then you will get to pay less taxes and to get larger properties and to have more income. In a quick, short summary, that's what I can talk to you about for 10 or 15 minutes. But I wanted to pause there to see if Patrice wanted to say anything else, or if you had any questions about that, or if I should share my screen with you. And the third option is to go into more detail on the 1031 exchanges.
So we can go into more detail with the 1031 exchanges because we work with a lot of our members that sell those properties for different investors, right? Or different properties that are sold and they have to purchase another property within a certain amount of time. So if you don't mind going into that spiel or that explanation, that would be great, Brother Jacob.
And I'll help you understand why it is that that amount of time is particularly important.
Mm-hmm.
Okay, so the key takeaways about a 1031 exchange is that if you sell the property, you want to avoid paying taxes on the increased value of that property and defer the capital gains as much as you can. When you sell that property, you cannot take the money yourself and hold on to it. If you're doing a 1031 exchange, you're going to need to have an escrow held by the money held by a third party that's going to help with this process. The two properties, the property that you're selling and the property that you're buying, have to be a similar kind of property. The new one should be of a higher value than the old one. And if you do it properly, there's no limit on how many times you can jump from property to property, as many times as you want. So let's
Within a
take
year's time frame or within a certain
within
time
your
frame?
lifetime, within a
Oh,
year or within a lifetime.
okay.
So you can, well, I'll just give you one example now, and this is one example, and you could do it 100 times and keep growing the properties that you're going to be selling to buy bigger properties.
Okay.
So let's take a look at this example of a 1031 exchange. You're selling a building that's worth $2 million, but it's double what you bought it for 7 years ago. So you bought it for $1 million or so. Okay. But so you're going to sell it and you're going to buy a property for $2.5 million instead. So
Mm-hmm.
you bought it for $1 million, you're selling it for $2 million. You would think you'd have to pay a lot of taxes on that. You're going to buy a $2 million property, $2.5 million property, and you're not going to pay taxes on it right now. Okay, how are we going to do that? Here's two examples. This is going to be the example of a standard real estate sale, and this is going to be an example of a 1031 exchange. Both properties selling for $2 million. Both properties have an adjusted basis of $800,000, and both properties have $100,000 worth of selling costs. Okay.
Mm-hmm.
Taxable gain on this first one would be about 1.1 million. Taxable gain is $1.1 million. And so if you have to pay taxes on that, you're going to have to pay taxes of about $261,000, unless Patrice tells me otherwise, which means you're left with $1,600,000 in order to buy a property with.
Okay.
If, however, you do a 1031 exchange that just costs a few $1,000s, you're going to have a lot more money to put down on the property that you're buying. You've got $1.9 million instead of $1.6 million. Board, any questions about that, or should I move on to the next slide?
No, I think you can move on, Brother Jacob.
More money is good. Okay.
Mhm.
So the second thing we're talking about is you need a third party. You need a qualified intermediary. Often, most title companies will act as your intermediary, but you don't have to even use the same title company, and you don't have to plan things out far in advance. But you
You know
do need,
what,
yeah.
Brother Jacob, I'm so sorry. I see Madam President hand is up. Madam President, you had something you wanted to share?
I did. Before you move on, Brother Jacob, this is great information. If this is your primary residence, is there, are you still taxed the same versus if it's an investment property?
So, private residences, oftentimes you can sell and then buy a new one and not have to pay certain taxes on that. Patrice, are you familiar more with that? Would you want to touch on that? I don't know if you can do that as many times or if there's a limit on how many times you can move up in your own personal residence.
Well, I didn't. I heard the last part of the question with the personal residence. What was the first part, Sanine?
The
I'm
first
sorry.
part is if you're selling your personal residence and buying a bigger house, do you have to pay tax immediately on that gain?
Do you pay taxes on the full amount? Do you pay taxes on just a certain portion of that? Is that tax deferred until you sell the next property? I'm just
So the IRS on your personal dwelling, if you are single, you get up to $250,000 that you can write off on selling your home without capital gain. If you are married, it's 500,000. So Selena, if you and your husband sold your home for 500,000, you wouldn't have to pay $1 on that because that's within the threshold.
Is it $500,000 of gain or $500,000 of house?
$500,000 of house. So if the house was 750,000 that they sold it for, then they would end up paying taxes on the 250 because the 500 would not be would not be taxed at all. So they would have to pay capital gains on the 250,000 on the difference of that. But if it's under 500,000, then they would be okay.
thank you guys.
Okay.
And Brother Jacob, before we go any further, is everyone able to see the slides on the screen?
Yes, I see it.
Okay. Okay. Thank you.
Okay, so you've chosen a qualified intermediary so that you're not holding on to the proceeds but the qualified intermediary will then use those proceeds to buy the next property. So here's the timeline that you were talking about. As brokers, you have to be really aware of if you're representing someone else. So step one is you're selling your property and the qualified intermediary accepts the proceeds. Within 45 days of step one, you have to identify replacement properties. So you can identify a handful of properties and say, I'm selling property one, and I'm probably going to buy either A, B, C, or D. It doesn't mean you can give them a whole bunch of them because deals fall through. That's okay. When you finally close, you have to do that within 180 days of when step one was.
Oh, okay.
So that's why that's particularly important. So the 45-day rule I just talked about a little bit later. If you don't name what some of the properties that you're going to buy within 45 days, then your 1031 spoils and you have to pay your taxes and you have to designate those potential properties. And then 180-day rule again, if you don't close within 180 days, then you lose out on the benefit of attempting to do a 1031. A reverse exchange is possible under certain circumstances. If you buy the big one first and then you sell the little one after that date. Okay, but you have to do it within a short amount of time. Implications of the tax. What happens if, let's say, you sell the first one for $2 million and then the second one turned out that you couldn't find one for over $2 million and it sold for a little bit less, then that's called a boot, and you'll have to pay a portion of the taxes at that time.
Got it. Brother Jacob, I think that the membership is absolutely paying attention. We have another question really quick from Madam Cheryl before
Great,
we go
thank
on to the next step. Madam
you.
Cheryl, if
Okay.
you want to unmute, you can go ahead and ask Brother Jacob your question.
Okay, so I was trying to be clear. So you said if it's less, then you're paying taxes because it's less the initial amount? So why do you pay taxes if it's less? Is that what you said, or am I misunderstanding what you said? And then I had another question, Patrice. I thought I remember reading somewhere that they were upping the amount of value for, a personal property to 650, or is that something that it's rolled back down to 550 or 500?
So the first question was the reason why you're getting a benefit for increasing the value of your holding, and you're using up all of the money that the third party was holding. If the third party doesn't send all of the money to buy the new property and instead sends it to you, then that's the amount you have to pay taxes on. And Patrice for question number 2. Looks like you're working to figure out how to unmute.
How to get it off mute.
Yes, I had to get back off. Sorry. So Cheryl, no, so maybe that's something that you heard, right? That's because we do hear things or things that are talked about. So I only go off of what is IRS law. So as of right now, and I just checked on the IRS website that's what I was doing real quick before I answered you. It's still $250,000 for one individual, a single individual, and then it's $500,000 for married, right? So there could be talks about things increasing, but it doesn't mean anything until it's on the actual IRS website. So, and that's kind of what I go off of with everything.
Thank you for that, Madam Patrice. Brother Jacob,
Shall I continue on 1031 exchanges?
go for it.
Okay. So one of the questions that someone might ask is, can you do a 1031 exchange on your principal residence? Not really. It has to be an income producing property. So theoretically, if you move out of your principal residence and then you rent it out for a while, then you could get some benefit of a 1031 exchange in that case, but not the full benefit. Okay, so it has to be like-kind property. We went over that. It has to be investment or business property only, not your personal residence. Replacement property should be of equal or greater value. Otherwise, if it's not, then there is a boot and you would have to pay for taxes. But if it is higher than the one you sold, then there is no boot and you don't have to pay taxes now. You must involve the same taxpayer. That's an important thing because we're talking about LLCs. If your LLC, Jacob's LLC, is a partial owner in the property and sells it, and then Jacob personally is going to buy another income producing property, then you can't take advantage of the 1031 exchange. Don't forget to within 45 days, identify potential properties that you're going to buy and buy them within 180 days after you sell yours. Those are the basic rules of a 1031 exchange. There's lots of details within those rules, and I'm happy to talk more about those later, but I want to hear more about what Patrice has to say.
Thank you, Brother Jacob. This was a lot of great information in such a short period of time with the 180 days and 45 days and the taxes that come through with that. How could someone delay the taxes if they wanted to, Brother Jacob?
How could you delay the taxes?
Mm-hmm.
So for example, let's go back and look at this at that first example. Here. So if you do the 1031 exchange, you're not paying $261,000 in taxes right now. You're going to delay that until you sell the second property. When you sell the second property, then you have to pay taxes on that 200, you have to pay that $261,000 of taxes, plus whatever the second property increased. So, but you've got now, maybe you've kept it for 10 or 20 years.
Mm-hmm.
You've gotten to have the value of that $261,000 of tax money right now. And guess what? If you die and you've never sold the second property, or let's
Mm-hmm.
say you've gone to a second or third or fourth or fifth, you keep doing 1031 exchanges, and now you've got a $150 million bill, or let's say you've got a $4 million building more, okay? And it's, oh, you're going to have to pay taxes on $2 million worth of increased values, but you passed away. Guess what?
What happens?
It resets. When someone dies, the value of their estate resets to the day of their death. So, for example, you had Disney, and when you bought the Disney, it was $100 a share. And when you died, it was $150. The day, let's say you sold it for $150 the day before you die, you have to pay
Mm-hmm.
taxes on $50. Let's say you didn't sell the shares of Disney and it went up to 150, you died, your kids do not have to pay taxes on that $50 gain. Likewise here, if you do the 1031 exchanges and your kids will not have to pay that $2 million worth of increased value that you've seen. If you've
Wow.
never, so you can delay, and maybe even not even have to pay the taxes.
Is there anything that you need to do in advance before doing
So
these?
when you get when you're selling property and you get it
Mm-hmm.
under contract, you have to talk to your attorney. If it's not me, whoever your attorney is, let
Okay.
them know that that you're already looking for a like kind purchase and that you would like to do a 1031 exchange. If you don't already have a 1031 exchange in third person intermediary, I or your attorney can introduce you to one.
Gotcha. So you have to let the attorney know upfront that you're doing the 1031 exchange when you're getting ready to sell your existing property, when you're purchasing one that looks similar to the one that you're selling.
Yep. As soon as you get it under contract, as soon as you talk to your attorney, let them know.
Okay. Thank you, Brother Jacob. Madam Cheryl. Okay. Go ahead, Madam Cheryl.
I know I always have questions for clarity. So Jacob, so what if I'm gonna give you a different scenario? So say I'm already down the line, did not set it up. Is there a time frame? Say the property is getting ready to close. I did not put this in a 1031 exchange or did not tell the attorney until day of closing. Is that too
It
late?
takes time. It takes some time to, theoretically, if you decide to do it the day of closing and you could talk to uh, the title company, maybe they'll hold the funds for a little while. Or you could postpone the closing for a couple of days while you get that set up.
Okay. And then, so once we do that, and I'm just, this is hypothetical, then I have 180 days to find a similar like property with higher values, is what you're
Don't
saying.
forget the 45 days, though. You've got 45 days to tell the government, these are the 5 or 10 properties I'm looking at. I think it'll be one of those. And then
Okay.
you've got 180 days to actually close on one of those 10.
So really, it's really 225 days then.
Total 120.
Oh, total 120. Okay.
Got it. And I think Madam President had her hand up.
Mine was just really quick about like kind. So like kind, is it as specific as condo to condo, single family to single family, or is it residential to residential, commercial to commercial?
Yeah, that should be close enough.
Okay.
We got a question in the chat. Can you transfer a 1031 exchange to someone else?
Nope. It's got to be the same company that sells that buys.
Gotcha. Thank you for that. And it looks like Madam Sherry, YRD, is in the building. Our membership chair for YRD, Sherry Jordan, got her hand up. Go ahead, Madam Sherry.
Thank you, Madam First VP. My question is, I know you said that in terms of a primary residence, it won't really work. But what if your primary residence was a 2-unit and you wanted to sell that one so you can purchase a 3 or 4-unit?
Then you will get some benefit of doing that. Not the full benefit, but some benefit. Plus, add it to the $250 or the $500,000 that we were talking about before. So if it has to be above that anyway, for that, so most likely you'll get some benefit.
Okay, thank you.
Thank you for that, Brother Jacob. Now, you know what? We're going to jump right into Madam Patrice, because a lot of people have been always asking about when you are writing off your on your Schedule C, your depreciation. Like you work a portion of, you work in your home, for example, and you can write off a portion of that space for depreciation. So, Madam Patrice, can you dive into that a little bit further?
Sure. Let me go ahead and am I able to share my screen or do I got to get? Okay, no, I can. I think I can.
Yeah, we see it now. Is that you having a, is it Tessa or Stessa?
Does it show tax tips?
Yep, I see it.
Okay. I'm gonna kind of go through some of this stuff. I kind of already introduced myself, so you all don't need to know that one. This is kind of what we discussed in the beginning for anyone who came in a little later when we were breaking down the self-employed. I kind of always just like to go into the different types of entities. So these were the ones that we kind of asked. I think LLC was number one. We did corporation, partnership, and then sole proprietorship, right?
Yep.
So like I said, depending on your entity structure and how you're taxed, it's going to play a big role in how we do tax strategy for you, right? And then every industry is different. So a real estate professional does not have the same deductions that a truck driver does, right? So that's again why we also want to make sure as far as like where you are. When I said earlier about the standard business deductions, these are kind of the standard, and you touched on that, Madam Fosta, right on top. Home office deduction is number one. But what I noticed is a lot of people don't use this home office deduction. So yeah, we'll discuss that really quickly. Mileage is another one, of course, especially those of you all that are real estate professionals. I'm sure that mileage is big and can help you with deductions. Business travel, and if you all didn't know, when you're traveling for business, you can write off your airline ticket, your hotel, whether you're staying in a hotel or Airbnb. As long as you are there for that entire time frame for business, then that entire trip could possibly be a deduction for you. When we did our conference last year, we were there for 5 days on business every single day. We had meals, right? We went out, we discussed business. Foster, you and I went out one of those days and had a meal, and I wrote it off on the receipt, right? So that you all have to remember that you all are entrepreneurs. And sometimes I feel like some of my real estate professionals don't remember that. You're a business owner, right? You're not just a broker selling homes. You are also an entrepreneur. So you need to remember and understand that everything that you're doing, you need to figure out, how can I turn this into a business expense? Right. And so for me, if I want to have lunch, I'm not saying, hey, Foster, let's go have lunch. I'm saying, hey, Foster, let's go talk about business. Let's discuss this particular topic. I'm going to help you. What are we working with you right now, Foster, with putting your package
Courses.
together for your membership, right? For you to be
Yeah.
able to create a course. So every time I'm talking with a friend or a professional, I'm going to use language that the IRS understands, and I'm going to make sure that I'm running my business that way. So literally, just from you thinking that you're an individual or you're a consumer, you have to now transition your mindset into the mindset of an entrepreneur. And the mindset of an entrepreneur, we want to save money. If I have to spend this money and I'm going to be charged taxes on it, and the IRS says, hey, if you're an entrepreneur, you're a business owner, especially when you're an LLC, corporation, S Corp, right? Sole proprietors, you all have a certain amount that you can write off, and I'm going to show the Schedule C. But it's different when you're a corporation. It's different when you're an S Corp. You have a even wider range of tax deductions. And so when you work with someone like myself, who's very big on that, I'm not just a tax professional, but I'm also an entrepreneur. So sometimes you come across people that are maybe a CPA, but maybe they've never had their own business, right? And so the difference with me, again, that's why I call myself the realist tax and business strategist, because I'm going to come in from both angles. I have the finance background, then I have the entrepreneurship background. I've been an entrepreneur for 15 years, and then the tax background. So we're going to put all three of those together, and we're going to make sure that we're saving you the most money as a business owner, right? So these are just some of the standard ones, right? When I shared that no matter what business you in, these are some of the standard ones. I do want to also give you all like I want to kind of skip this real quick because I want to kind of give you some real bread on here, right? Some real, as I like to say, some real game while we in this private session. Record keeping is cool, yes, but I want to share this strategy with you, right? So I'm a corporation. My company is P. Stewart and Associates, Inc. Now, I set my company up almost 15 years ago. So in Illinois, to set up an LLC, it was like $500. So it was cheaper for me to set up a corporation. So that's why I originally set up my entity as a corporation, right? But I also became an S Corp a year later. So when you're a corporation and an S Corp, there are certain strategies that we can use. So I'm going to give you this example. Because you're a corporation, you have to have an annual meeting, right? You have a board, you have board members, you have an actual president, vice president, secretary, treasurer, et cetera. When you're an LLC, you don't have that. When you're an LLC, you are members of that organization. So it's different. And that's why I wanted to stress in the beginning, the entity structure is going to be huge with how you're able to take advantage of the tax code. So because I have to have an annual meeting every single year, I strategize. What would I want to do? So I wait to host my annual meeting around my birthday. Okay. If I know I have to have an annual meeting, this particular year in 2022, the IRS allowed us to write off 100% of our meal deduction. Normally, you only get 50% of your meal deduction. But in 2022, we were able to write off 100% of our meal. So again, if I have to have an annual meeting, I want to go somewhere that I'm going to enjoy. Also, with that annual meeting, your entire board has to be there, okay? So I ended up renting a mansion in Miami. I love Miami. I ended up renting a mansion, which is this first photo here. I hired a private chef, which is now a contractor, okay? So he is a contractor, so I hire him to come in and actually cook and make the meals for us for the 4 days that we were staying there, okay? So now my meal is covered, but that's a tax deduction for me. The mansion is a tax deduction, okay? So I'm able to experience my life, live my best life. My mother is on my board. My mother has always been a board member. So my mother's listed as my secretary on my board. My cousin is also a board member. And then my, she no longer works for me, but at the time, my assistant added her on as a board member. So all of your board has to be there. So all four of us were there. I flew us out. Our airline tickets, our mansion stay, right? All was covered. All that's a tax deduction from my company. The other thing that I did was I held my goddaughter's birthday is the day before mine. So the day after mine. And so her mom brought her down to Miami the same weekend. So I surprised them and did a leadership brunch. My goddaughter is an entrepreneur. She She started hustling and doing business at 15. I love her. She a Gemini just like me. So, so I told her, you know, we surprised her. This is the photo here with her and her friends. We had a brunch, right? I was already paying him to cook. So now I'm doing my charity because I also like to give back and, you know, make sure that we're empowering the youth. So her and her friends came over to the mansion. We had a nice day. They got to go hang out in the pool. And then we had a brunch, right? We had an actual sit down. But then I actually did a session with them. So this is me here in the middle. We're there. They have little notebooks and pens that I gave them. And we talked about them having business ideas. Some of her friends have businesses as well. So I also hired a event planner who is my friend. She owns an event company. That's her standing back here, Dora. And she hired me a photographer for that same time frame. So I'm able to do content creation, marketing. I'm able to fly my family, who's my board, out, okay, for our annual meeting. And when you do these annual meetings, they don't have to be in your city. If you wanted to go to London, if you wanted to go to Italy, you can. You just have to plan it. You have to strategize and you have to put everything together for it to make sense. But that can be a legal tax write-off and deduction. And a lot of you all have family that may or may not be helping you in your business, but if you have children that are in your business, you definitely should be talking to them about being a part of the business. Because also when you have a business and you have children under 18, you can actually pay them. You can actually give them a formal payroll, you know, salary, give them a specific time frame, number of hours that they're working a week, 15 hours a week at this dollar amount, and you're able to write off that entire amount that you paid them. So if you paid them that $10,000 for working in your business, that's going to help your family, which technically they should be doing, right? But now, so what some clients do is they defer that payment. Instead of giving it directly to the kids, some of them put it in their children's IRA account, right? Some of them actually do pay their kids if their kids actually have things or have a business that they need to do. But now that's another way for you to utilize that income that you're making, and you're able to write it off because now you've paid your child that lives in the house with you, that you're feeding, you're doing everything for. So now they're able to give you a tax deduction, right? So we have, again, these are things that we have to think about, but you won't know that if you're not working with the right tax person. And so the last
you're
point,
talking about, could I add one little piece?
yes.
Go ahead,
when
brother.
that sometimes they defer it by putting it in their kids' IRA. Well, guess what? You could put it in your kids' Roth IRA,
Right.
and boom, all of the growth on that Roth IRA, no taxes.
No tax. Right. You're right, Brother Jacob. Thank you for saying that, because I meant to say Roth IRA. Most people, 99% of the clients that do that, do it in a Roth IRA. Yeah.
Mhm.
Yeah.
Nice.
And
Well,
like you said, that's
you're just
completely
not gonna
taxable.
drop no IRA on us, Madam Patrice, and don't say what and Brother Jacob, what is a Roth IRA? Where do we get those from? You know, drop all of the tea.
Patrice, you want to talk about the quick on the two types of IRAs, or do you want me to?
I want you to, because I'm not well versed on the IRA since I kind of been out the corporate. I know self-employed, but I'm not real well versed with the Roth and the traditional.
A general IRA,
Mhm.
you don't pay taxes on it right now. A general IRA. So let's say you put $1,000 into your regular IRA, and over time it grows to $2,500, and then at some point you take it out. You have to pay taxes both on the original 1,000 because you never paid taxes on it, and you have to pay taxes on the additional 1,500 because it grew, but you pay it at the tax rate whenever you take it out of your IRA as you're older. So that's a regular IRA. A Roth IRA is a little bit different. You do pay taxes on the income right now, but your children are at such a small rate that if they're earning less than, what is it, $2,000, Patrice? I don't, do you know offhand?
I don't remember the exact, but it's not a high rate like you said.
Right. If you're under like 2,000 or whatever the number is, then your kids aren't going to have to pay taxes now. But let's say you're an adult and you earn $1,000 now and you want to put in a Roth IRA. You pay taxes on the $1,000 now, and maybe you only put $800 into the Roth IRA. But over 10 or 20 years, it grows to be $2,000. When you take that $2,000 out, you pay no taxes at all whatsoever, because you've already paid taxes at the time that you put it in. Everything grows tax-free.
Nice. Now, Brother Jacob, how do you set up a Roth IRA? Who do you go to? Do they go to you to set up that Roth IRA? Who do they go to?
Most large banks will have places that will help you invest your funds. I'm happy to introduce you to various people. I'm sure that Patrice can introduce you to people. There's people on our board that are investment professionals that can help you set up a regular IRA or a Roth IRA. And again, the difference is for a regular IRA, you're deferring the tax payment. You don't have to pay taxes on that right now. On the Roth IRA, you do pay taxes on that right now, but you don't pay anything later as it grows.
Gotcha.
Yep. Yep. And then for people that are kind of, a little investment savvy, if you have accounts like E-Trade, Fidelity, you can also set up on there as well. I have both traditional and a Roth that I just set up on my own on E-Trade. I mean, on Fidelity. I like Fidelity a little better. But that's for those, like I said, who kind of already investment savvy. Otherwise, then right, like Brother Jacob said, we can refer you to someone to set that up.
And you know what? As long as we're talking about that, you could do that, and you can invest those funds in stock markets or whatever else like that. There's a couple of other companies that, if you've ever heard of a self-directed IRA, you could put the money into a self-directed IRA at one of these other companies, and then you could direct that company to buy a house. When you buy that house into the IRA, and if you buy it as a Roth IRA and it grows from $100,000 to $200,000, forget 1031 exchanges. When you sell the house, it goes back into the Roth IRA and you don't have to pay any taxes on it.
Wow.
Yeah,
that
now
was a
Jacob's
lot
getting
right
into the
there.
real
That was a
strategies now.
lot getting
Yeah,
into
yeah,
the
yeah.
nitty
Now he
gritty
getting
right
to
there.
that.
That was in the weeds, Brother Jacob.
Yeah.
That's in the weeds, but it's out there. And
Mhm.
you don't have to remember it right now. One day you could call me and say, Jacob, what was that you were talking about? Roth IRAs and self-directed. What was that? I'll remind you.
Love it. Love that.
Oh,
So
well, I
with
will be
the
calling.
uh-oh, I didn't catch who that was that said they'll be calling.
I'm sorry. I get a little Tourette sometime and blurt stuff out.
Oh,
It
is
was
that
me,
Letitia?
Letitia.
Madam Letitia?
Madam Letitia.
Excited. You guys are doing amazing. So thank you. I just got excited. My
I
bad.
know
Oh, no
you have
problem,
my
Madam
phone
Letitia.
number, but in case
I have
someone
two of
doesn't
your
have my
numbers.
phone number, I'll tell it to you now and I'll put it in the chat. It's 312-967-9963. Or you could just send me an email or catch me at one of the meetings.
Yeah, we have Madam President placed it in the chat. This is what you get when you are a member. You get access. You are networking with the who's and the experts in their field. This is what you receive. Madam Patrice dropped some real good gems with the annual meeting, writing everything off. We was just talking about this earlier, Madam President, the access and the network. I see your hand raised. Go ahead, Madam President.
I'm sorry. We just can't just blow past that amazing tax strategy right there. So, okay. Couple things I heard that I'm just like, we having our annual meeting in Dubai and we're writing it off. I mean, obviously you have to be able to afford the costs up front in order to be able to write it off. I think that's another thing that we hear a lot about is write-offs, but it's still an expense out of pocket today. Right, that you then write off at a later time. So you still have to be able to afford that expense. But what I heard was strategy, right? Thinking strategically. This is something I was going to do anyway. So why don't I work this into, my business and figure out a way to write this off. So I love thinking strategically because that's what we have to do as business owners. And we're not always taught that. Again, oftentimes we kind of trip into entrepreneurship. We had a great idea. We saw somebody else do it. We wanted to do it. It looks like something we wanted to do. And now we're doing it. But we didn't necessarily start with all of the foundational items in place. But Jacob, my question to you was with this self-directed IRA, right? The entity that purchases the property, is that you as the taxpayer? Is that your LLC?
So your question, ask the question one more time.
The self-directed IRA, I wanted you to delve a little bit deeper into that without us getting off track. And if it is, then we can talk offline. But
No, we have some moments. We have some time. We're going with good time, Madam President.
That really piqued my interest. And I know we have a lot of investors / entrepreneurs, it kind of intertwines our worlds, I think that's a great opportunity for those who may not have known that they can do that. Talk more about that strategy.
Okay, so you have to have some money in a Roth IRA. You have to move that Roth IRA to one of the couple companies that allow for self-directed IRAs. Then you have to find a property and direct the company to purchase that property and have it be owned by your IRA, your Roth IRA. But meanwhile, they also hire a company to manage the property and to be dealing with the day-to-day basis of bringing in the rents and everything else like that. That answered a little bit of Jennifer Crisp's question, but it's also Roth IRAs it's money that you yourself own. It's not your company's money. And then again, when you sell that property, the money goes back into the Roth IRA. And if you're not old enough to start pulling from the IRA, it has to stay in the IRA. So you don't have real easy access to that money, except for that you could direct the IRA to purchase something else. But if you want to use that money to go to Dubai or to pay your phone bill, it's not easily accessible for that.
Right. But you avoid the capital gains taxes that you would normally pay if it weren't in the self-directed IRA.
Right. I mean, so you can avoid the gain through the self-directed Roth IRA. You can also avoid the gain right now by using a 1031 exchange.
Great. Thank
But
you.
for the 1031 exchange, you have to go through, there's pluses and minuses of both. For the 1031, you need to buy another one. You need to buy another within a certain amount of time. And if you don't, then blah, blah, blah. And you have to pay a fee. With the self-directed IRA, you're paying them a fee also to be able to manage it. It's not as much as a 1031 usually. But there's fees to that. Nothing in life is easy.
Yeah. You're deferring the taxes or either it's tax-free growth. I see Cecilia's notes in the chat. Awesome. Yeah. Oh no, Jennifer said she already messed up.
Oh no, Jennifer, you gotta tap in and have a conversation with Brother Jacob so he can help out with that. I love us kicking this off in the beginning of the year for the taxes and the 1031 exchange. Madam Patrice, did you want to add on to like the Schedule E when you're selling off like the rental property or the talking through the rental properties for the property taxes?
Let me see. I don't think we put it in the thing. I had her do.
Okay.
So let me see. If I switch my screen, can you see it again? This shows the Schedule C.
Yep, we see the Schedule C. Yep.
Okay, perfect. So basically what I was sharing with you all, like with the Schedule C. So for those of you all who are single member LLCs and sole proprietors, this is the form that you normally see, right?
Yep.
So you do have options to utilize all of these boxes, right? Sometimes when I see people's taxes, they only have like maybe one or two or three boxes on here. And I'm like, if you're a business, you should be utilizing and writing off, kind of what you need. Now, let me also say this. Writing off everything is not good, not all the time, right? So let me say it like this. Every single year for your taxes is going to be different, right?
Right.
If you know that you're purchasing, you're looking to work with Madam Fosta, Madam Sanina, and get a property, right? Then you know that when you come to me, we cannot come and be extra aggressive with your tax deductions, right? Because we need to keep as much money as possible. So if you're making $100,000, we need you to show that in that income, right? And so some years we may be really aggressive here, right? We may get really aggressive, but when you know that there's things that you're looking to do, whether you're looking to get a loan, whether you're looking to purchase property, whether you're looking, to actually show income and grow, then you cannot be as aggressive with your deduction. So I like to let clients know every single year is not going to be the same, right? So in this particular case, if we know you're looking to buy a property, you need to show as much income for those last 2 years. So we may not be aggressive here. This also, the Schedule C is also the only form where you can take the home office deduction. Okay. If you're a corporation like myself, I don't have the home office deduction, right? But that's part of the reason why I always had an office, why I have a physical office where people can come in, a commercial space, because that is a tax write-off and a deduction for me. So I have a small home office, but I can't write that off, right? And so even for you, if you all have an actual location, because like Sanina, you have an actual commercial space and you have a home office just like me, you have to decide which one you want to claim if you were filing on a Schedule C. You can't do both. You can't write off both of those. You have to write off wherever you are the most. So if I'm at my commercial space the most, that's the one that I have to write off. I can't write off my home office, right? But for some of you all who are working out of your home and you are utilizing your whole home, yes, a lot of people don't take that deduction. And let me not say your whole home. Let's say an area. If you have 1,000 square foot home and maybe you have a room that's around 200 square feet, then the IRS will give you will allow you to take about 20%. The maximum that you could take on a home office deduction is 30%, right? So either you're writing off $100 of your mortgage or rent payment every month, or you're writing off $200, which would be 20%, or your maximum would be $300 at 30%. But if your mortgage, and I'm just throwing easy numbers out, right? I don't know how many mortgages are $1,000 anymore. Those was the good old days. But if your mortgage is $1,000 still, then you can write up to 30% off, but it's going to be based off of your square footage. So the example we'll use, your square footage is 200. So that's $200 every month that you get to write off for your mortgage or your rent payment, right? $2,400 for the whole year. That's a deduction that people are missing. You can also write off your light, your gas, because again, you're at home. So you need the heat, you need the light on for you to be able to work, right? So that's 20% of your ComEd bill, 20% of your people's gas bill every single month. Right.
Gotcha.
And in the winter times, that adds up. My gas bill is like $300 right now, right? With the heat being on every day. So if I'm able to take 20% of that, that helps me again as a business owner. So, and some people used to tell me like, oh, well, you can get audited if you do certain things. Let's just be clear. With the IRS, as far as the business that you're in, the expense has to be ordinary and it has to be necessary. So in your industry, in your line of business, if it's ordinary and necessary, then that is a valid expense. And as long as you have your receipts, not just your bank statements, not just your charges, I need y'all to know that too. You need to actually take a photo of your receipt. I have a folder in my phone, and all of my receipts, when I'm doing meals, when I'm buying things out, or if I get an invoice, I'm saving that in that folder with that month. You want to save your receipts by month, and by in that year. Because if you ever get audited, the IRS is going to come and pull, and they're going to say, well, we want to see what receipts you got from January or what receipts you got from September. It's not going to be a chronological order. They're going to randomly do things because they want to make sure that you're keeping up with your paperwork. And so the biggest thing that you need to remember is to maintain your receipts. And a lot of people think that, oh, my bank statement is enough. No, your bank statement is not a receipt, because your bank statement just shows that you charged, you made a charge at Home Depot. The receipt shows what you actually bought from Home Depot. That's
Gotcha.
how people get caught up. And also with the IRS, you want to make sure that you're not commingling your funds. So if you are an entrepreneur, you have to have a business account and you have to have a personal account. You should not be running everything, your business, your real estate company, all through your personal account. That's the easiest way to get audited and to not pass an audit, because you're commingling funds. So if you pull up a bank statement and everything is mixed in, you automatically are not are done with that audit. Okay, you're going to owe all of those funds, because now they can't determine what really was business.
Love it.
The other thing I wanted to show you was the Schedule E.
Okay.
So some of you
Wait,
all,
before we go into the Schedule E, Madam Patrice, we got
oh, I'm sorry. I
April.
was just
April asked,
talking.
what was that app that you're using for the receipt? The receipt folder app?
So I personally use QuickBooks, right?
Okay.
So as far as your accounting system may or may not offer different things. But when I was saying that, I don't have an actual app. I was saying in my phone, in photos. When in
Okay.
your actual photos, you can create folders. So in my actual photos, I have folders, right? And so because I don't want to keep paperwork all year. So if you don't want to keep the paper, you need to at least scan it in, have a photo of it, scan it in or something, so that way you don't have to keep the formal paper, but you have an actual record of the receipt, if that makes
Okay.
sense. But yeah, that was just my regular photos that I was saying about that, April, for the folder.
Gotcha. And
Okay,
you
that was the
saying
only other one
the
we had.
Schedule
Okay,
E? Yep.
for the Schedule E. So I wanted you all, because again, I have a lot of clients that come to me. I'm like, do you have property? And they're like, yeah, but I'm not claiming it. And I'm like, why? They're scared to claim the property because they don't want to claim the income. But what they were missing, again, when you talk to a professional, what they were missing was, you may have made $24,000 in rent payments, but guess what? You also have all of these expenses that you're able to write off because you have this business, because you have this rental property. So because this person may have made $24,000, right? But if you had to pay $10,000 in insurance, guess what? Now that's a $10,000 deduction on this line item. If you had legal and professional fees, you had to pay your attorney. You had to pay Jacob to come in and do some things for you. Maybe he charged you $2,500. Now that's $12,500 that you're writing off, right? Again, repairs, taxes, if you're paying interest, if you're paying insurance, everyone has insurance on their property, right? If you're paying a property management company, right? All of this is a part of your expense for managing and maintaining this real estate property. And we haven't even included the depreciation. So the depreciation is a whole nother other form that when you have real estate, you get to depreciate that property for 27.5 years. Okay. 27.5 years. All right, you all. That's a huge deduction. I mean, on average, some of my clients, we have seen $50,000 as a tax deduction on depreciating their property. And again, you're able to do this depreciation every single year, as long as you own that property, up to 27.5 years. So this is another reason why a lot of people get into real estate, because of the different advantages and the different tax strategies that you can utilize between myself and Jacob. It's just, it becomes broader for people to be able to save their money, right? And ultimately, that's what we're all trying to do. The more money we make, we're not trying to pay the IRS unnecessarily when they have all of these different things in the laws that say, hey, business, you get to deduct this. But again, we're so used to being consumers and just filing our personal taxes, we don't think about the advantages of having these businesses and how much really business business has the best tax laws and deductions across this country, point blank, period. You don't get much with a single family home, right? When you buy your single family home, you can only write off your interest and your taxes. That's it.
Mhm.
If you rehab your kitchen, the IRS is not giving you a credit for that because that's your dwelling. They consider that you'll get that when you actually sell the home,
Okay.
right? But that is the reason why I set up my property. Well, I set up my real estate management company, and I purchased my family house under my LLC. And the reason why I did that was, again, because I was able to get bigger and better deductions purchasing that property under a company versus purchasing it individually and only being able to write off the taxes and the interest. When I bought it under my LLC, I had this. Okay. I had this, but then I also had the business parts to this. So you can use this as a personal individual on a Schedule E. If you have your personal, I'm sorry, not personal. This is only for rental property, right? And that's what I'm saying. If you're buying property and it's your personal use and you're not using it as the business, you're not getting the full write-offs and deductions that you really could be. And this is for every property you have. So you can take depreciation on, if you have 3 properties, you'll have a Schedule E for each property.
Each property.
Yes,
Mhm.
that's how people are winning, right? A lot of people don't like Trump, but I like to always use his taxes because Trump had over 500 S corporations on his tax return. Okay, let's be clear. So when get out of your feelings when it comes to business, look at the laws, look at the information and not the person, right? But I like to always use him because everyone was going about, oh, he paid $750 in 2018. Yeah, because the 3 different firms that he had knew what they were doing. Those taxes were scrutinized, but those taxes were correct. I sat in on one of those meetings with one of those firms, and they went over everything. Every single thing was a legal tax deduction, but it's because under the business tax laws. So average personal people don't get that, right? But you all have an opportunity to understand this because you are a business. You have a business.
Madam Patrice, don't get her started. You see how passionate she gets.
Because I will go in. I'm gonna tell people that's why I'm the realist, right? I'm gonna get up out your feelings. Money and business, money and feelings, money and emotions don't make sense. Business and emotions don't make sense, right? What makes sense is the dollars. What Nipsey say? What you make, what you gross. That's what we want to know, right? At the end of the day, we want to know what you made. How much money did you make? Cece want to know what you make. She don't want to see a negative 20,000 Schedule C. You can't buy a house with that.
Absolutely not.
Selena and Fosta can't go get you a $300,000 house with a negative 20,000 Schedule C. It makes no sense.
Absolutely.
Right? And that's you working with people who don't understand.
I think that's the importance of this conversation is because there's a transition, right? Because when I had a 9-to-5 job, the way that my tax person prepared my taxes, I'm trying to get a refund, right? You're trying to get a tax return. So we're trying to write off as much and all this stuff, right? Now, that's a poverty mindset, by the way.
Yes, it is. Come on.
But now that we're in entrepreneurship, we have to switch over to an abundance mindset, right? I'm making money now strategically. I don't need to show everything, but I do need to show some things. And when we talk about tax write-offs, I think oftentimes people are so afraid. I'm really myself learning this whole tax code language because we missed so many deductions. I could talk about me. I missed so many deductions thinking it was like some kind of feather in my cap to show how much money I made. Ma'am, your tax bill is now 5 figures, right? So I don't ever want to do that again. So that was a miss, right? So now I'm like, okay, how do I strategically ensure that doesn't happen again? Because you start making a certain amount of money, that's great, but then you have to protect that. Otherwise, now you're paying more in taxes. So I love your passion because I'm passionate too, but it's personal for me because I'm just like, somebody needs to know what I did wrong. Like in the chat, the young lady said she messed up. Me too. I messed up, right? But I'm learning how to not mess up again because I don't want to give away 30 and 40% of my income. That's ridiculous.
Right.
Absolutely.
Right.
Absolutely. Let's
And
bring
that was
it.
a
Let's
great
bring
thing.
it. That
Yeah,
was.
that was a great point, Madam President. And I mean, and that's really what it is. Like she said, ultimately, and that's what I wanted you all to understand. You ultimately, you're going to start off on that Schedule C, but we want you to graduate from that Schedule C because you're paying the most in taxes on that Schedule C. You're paying 36% on that Schedule C. So if you made 100,000, you're paying 36% with no write-offs. And that's why most people don't want to claim the money, right? But that's why we get to the point where we say, if you're making 100,000, now you should be looking at, maybe we should be looking at you doing an S corp with that LLC, right? Or maybe we should looking at another tax strategy or a way for you. So as you grow, you do have to understand, like Madam President said, you also have to grow in mindset, right? You can't work with the same people that you were working with before. Maybe you was working with a little hustler in the basement that would write off whatever. Now you have to grow up and be like, okay, Patrice, now I'm ready to sit down with you because now I'm going in a different tax bracket. So it makes way more sense for Sanina to come and say, hey, let's look at this. So now she doesn't have to maybe pay that 5-figure. We can maybe do a strategy and put something else in where she's paying less. So
Love it. Love it. Was this helpful membership? Drop some fire in the chat. Drop some ones and twos in the chat, membership. Love that. Love that. Drop some hearts. Thank you. We want to bring in next. First off, let me say thank you for our leadership and our experts for coming in and sharing all of your knowledge. Madam Patrice, can you do me a huge favor and drop your phone number or contact info in the chat for the members? And Brother Jacob, if you can do the same, that would be outstanding.
yeah, and then I just also put it on the screen really quick, but I'm typing it in right now.
Good, good, good. Wonderful. So now we do have our wonderful membership chair who is up next to share a couple words for membership. Madam Candy.
Let me
Oh,
shut
you on mute.
Oh, yeah. Thank you, Madam First. Thank you, Brother Jacob and Madam Patrice, for dropping the gems for our membership today. Thank you, membership, for tuning in. I hope that you all received this great information. And I just have a few updates for you. Um, our leadership applications are coming out. The applications will be coming out on January 20th. So if you are interested in joining this amazing organization and becoming a leader, please make sure that you apply. The elections will be held at our next monthly membership meeting, which will be February 13th. February 13th will be our next meeting. Also, just a few housekeeping tips for our membership. Please update your profile. As you renew, please list your telephone number, your email address, more information than just your name. We often have opportunities for our membership and we have no way to reach out or connect to you directly. So this would be greatly appreciated and very helpful. Lastly, if you have not renewed, please renew your membership. We need your membership so that we can continue to bring you presenters like Madam Patrice and Brother Jacob. We need you to renew your membership. If
We
you
cost a lot.
huh?
We cost a lot to bring.
Well, there are benefits to being a member, as you can see. So please renew your membership. Oh, we also have our national conference. I almost forgot in February. That's coming up. The national conference will be held in Florida. So if you have not received the information about that, please check the website. All that information is there. Fort Lauderdale. Thank you, Madam CC. And I believe that's all we have for membership updates right now.
Amazing. Thank you so much.
Yeah.
Our membership chair, Madam Candy, works tirelessly on membership, and we're so grateful. She's the best membership chair across the country.
That's
And I put her up against anyone across the country. Thank you so much, Madam Candy, for
Thank
that.
you.
Now, we have a treat. I thought I saw on here our wonderful RVP on here to share and bring some news from the Nationals. Brother Sidney, are you here with us? Do you mind unmuting to share all of the national news that you have?
I am. Thank you, Madam First VP. To my home squad, awesome presentation. Awesome. Patrice, you're hired. Brother Jacob, you're hired. I apologize, guys. My camera is I can't seem to get it cleared up, but do have some great information from the national level. Uh, Welcome, everyone. It's time to kick off that 2020-2025 year. Awesome updates, a lot going on. Of course, your national president is always on fire, always moving. There's a lot going on. Kind of piggyback off of our Madam membership chair, the Midwinter Conference will be in February 22nd through the 26th in Fort Lauderdale, Florida. I tell you guys, we got a hot lineup for that. From what I understand and what I've been peeping, I know Egypt Sherrod from HGTV will be there doing a few things with a couple of other celebrity guests that
Nice.
you don't want to miss. When I tell you, I know folks have been fussing about the cost of this, but it's worth it. It's in Fort Lauderdale. It's going to be on the beach. Try to be there this year for that. Now, a little bit of national notes, some compliance. This is going out to the leadership here, our Dearborn Realtist board. They're going to be, the Nationals decided they want to start updating or keeping up with local boards and their bylaws and guidelines. So look for that to be coming out real soon. They're going to be asking for that information as you come along and going from there. Let's see, some key reminders. Of course, we went through midwinter. What else we got? Chiba Report, Brain Trust. That data will be given out midwinter by Hill Harper. You guys know the superstar Hill Harper. He's going to be there giving us information on what's going on. Realtors Week, April is coming up this year. Look for more information on that, guys. We got to be ready for Realtors Week. It's going to be a major kickoff for our Building Black Wealth Tour, which Madam President is hot on. She definitely wants to do 100 city tour. Chicago is on there. We always kick it when it comes to that. So make sure we look for that. Black History Month coming up. February 11th, save that date. February 11th will be the actual virtual Black Wealth Tour kickoff. Look for more information from National on that. It's coming up.
Okay.
Builders Academy. They're going national with the Builders Academy. I think the deadline may have been January 15th, but if we have some local members that are interested in the Builders Academy from a national level, please send me an email if you missed that deadline. But I do believe it was the 15th, which was yesterday. But, you know, we can try to get a few more people in. There's 8 different cohorts with 200 participants. We definitely want to get as many people from our region in there and then going from there, okay?
Gotcha.
What else we have? There's going to be a host of private master classes going on. Get involved, jump in. I'm just ecstatic at the information that I just received. I'm like literally writing down, can we get, Matt Fosta, can we get a part 2 to this? Because this was really good. Right
Oh,
before
okay.
tax deadline, we definitely need to get a little more information as well.
Back by popular demand. Listen, I'll see what I
No
can
doubt.
do. You know, I know the speaker, so I'll see what I can do if I can get them to come back for a part 2. Okay.
Definitely would appreciate that. I think we all can develop and learn from that information, especially these real estate brokers who do things. So I think that's all I have for you guys on the
Amazing.
update side. I love my home team. Look forward to seeing you guys at midwinter and what's coming up in our particular region.
Outstanding. Thank you, RVP Region 9. You see it, Brother Sid in the building. Thank you so much for coming in and dropping in national updates on us. We absolutely love it. I want to bring it over to our Madam Second VP so she can share this update that she has coming up in February. She's been doing amazing on this every year. So she's going to just drop a quick teaser for what we got. It's not for the members, but you know we always working for Black History Month. So Madam Second VP, I just want you to drop a little real
Huh?
quick, okay?
You're so silly. I'm like, huh? Look, and I'm in the chat because I was excited to share with the membership. I was trying to get Madam Candy to jump back on here and acknowledge our chapter for being recognized nationally as the fourth place chapter across the country. We have over 100 chapters across the country. So I don't know if you all get that it's a big deal that we coming in the top 10 in 2024,
Look,
but in 2025, listen, we coming for number one.
That's
That's
So,
right.
right. Yes.
with that being said, I want to acknowledge all of our leaders, all of our board of directors. And for February, we always host the State of Housing in Black America. As we know, the Black home ownership, the numbers have not increased at the same pace as other cultures have. And so every year we like to be able to share what the statistics are as it relates to Black home ownership. And then we like to break it down by state and by county so that we can then begin to engage at a different level and know what those spots are that we need to be working with our buyers and our sellers on, and what are the pitfalls, what are the areas, what are those vulnerabilities. And so I'm excited that the State of Housing in Black America is scheduled for February 20th. We have just received confirmation from James Carr, the architect of the State of Housing in Black America. So I would say I'd like to see y'all there. However, this is this one is invite only.
Yes, it is.
I'm just excited, and thank you, Madam Fosta, for giving me an opportunity to share.
Listen, Madam Second, you work so tirelessly and passionate behind the scenes of everything that you do. I absolutely would love for you to share what you have been working on with the State of Housing in Black America. And then our first quarter is pretty robust. After the Sheba report, we have our annual gala, the installation gala. Save the date, March 27th. We'll have more details to come soon with the transition of the new board and the new administration, because our Madam President, this is her last year, her woo-ha with us. But we want to make sure we keep you guys in tune. We mentioned the Realtist Week that's coming right after the gala. So Realtist Week is like our spirit week. We're getting pumped and getting ready for leading up to our community day. So stay tuned, stay hooked. Madam President, did you have anything you wanted to share before we jump off?
Final words. My question or my ask is, who's next? Who is next in terms of
Oh.
leadership? Who is
Oh,
coming down the pike to be a part of the Dearborn Realtist Board leadership? Leaders make more leaders, right? And so our task and our charge for each one of the current board members is to reach back and invite someone else to be a part of this amazing leadership organization. We've all grown and been stretched so drastically over the last several years, having just been a part and having the privilege to serve, right? Leaders serve. That's what a leader does. Before they are served, they actually serve the organization. So who's next? February 13th is our next membership meeting. We're hosting our election. You guys should have received an email. In addition to our elections, when those board applications come out, be sure to complete those expeditiously because we'll have interviews, and then the election will happen on February 13th. We also sent out an email notification that we are looking to make a proposed amendment to our bylaws. The Dearborn Realtist Board is an 84-year-old institution, and we want to continue to move the organization forward and update the governing documents to ensure that we have the best talent, the best suited to be able to do so. The organization started out as real estate brokers, And we now have affiliates. Affiliates include our loan officers. Includes our general contractors, our appraisers. And so we want to make sure that they're all a part of the work that we do in an impactful and a meaningful way. And so review the information that we sent over to you. Let me know if you have any questions. You can definitely email me directly or email the Dread Mail email address. But be sure that you've renewed your membership, because at the February 13th meeting, you will be required to have renewed in order to participate. So thank you guys so much for joining us today. This was outstanding. The tax conversation to me is always one that's kind of like, this one was robust. I'm excited. I don't know about you, but I'm calling Patrice when I hang up, because baby, I can't never pay these people almost told my business. 5 figures. Almost told my whole business, but I can't do it. So Jacob, you are already my attorney. So yes, thank you guys so much. And this was outstanding. Thank you, membership. Have a great evening.
Wonderful. Thank you, Madam President. Enjoy your night, everyone.